Welcome to today's lesson in mathematics. I know it's commerce, but this is going to be mathematics in commerce. Okay, that is financing business units part 3. Okay, don't forget to check us out on Pathfinder. You can also recommend the app, it's on Android. You can find other tutors, other grades, other subjects, and study materials there. Okay, so we look at some of the financial and inventory formulas. Okay, so inventory refers to items that are within the company for day-to-day operations or not. Okay, so the first one is working capital, which is equal to current assets minus current liabilities. I introduced working capital in lesson 1. Okay, but anyway, we can take a look at working capital. There is no harm in revising. So what is working capital? Working capital is just the amount of money available for a business's day-to-day operations. Okay, so according to the formula here, it is the difference between current assets, which are all the assets the business has, minus current liabilities, which are liabilities that do not belong to the business. Now, current assets are assets that can easily be converted to cash, okay? And current liabilities are those items that need to be paid back to the owners in a short time, okay? So anyway, let's look at the actual definitions. So current assets are assets convertible to cash within a year, e.g. cash inventory and receivables. Well, current liabilities are obligations due within a year, meaning that the things you are supposed to pay back to other entities within a year, such as accounts payable and some short-term loans. Okay, accounts receivables are money you're expecting to receive. Accounts payables are money you're expecting to pay. Okay, let's take a look at examples. Mathematics without examples is difficult to understand. Okay, so here is an example. A business has current assets of 50,000 kwacha and current liabilities of 20,000 kwacha. Okay, so what is the working capital? So working capital is the current assets, 50,000, minus current liabilities, 20,000, which gives us 30,000. Okay, so in short, the business has 30,000 for term. Let me say that again. Let me read that again. The business has 30,000 for short-term needs. Okay, meaning that yes, they may have 50,000, but 20,000 is not theirs, so they actually have 30,000 for short-term needs. Okay. Another example: a retailer's current assets of 120,000 and current liabilities of 70,000. What is the working capital? You can pause the video and try. Okay, so the working capital is current assets, which is 120,000, minus current liabilities, 70,000, which gives us 50,000. So in short, the retailer has 50,000 available. Of course, they have 120,000, but 70 is not theirs. They have to pay back 70,000. The next definition, the next formula is turnover. Okay, if you are doing business, please know these formulas. Okay, I remember at some point I went to deposit some money for my business, Blugam, at the bank. So I was asked, what's the turnover? I was like, what turnover? Are we going to be talking about commerce again? Yeah, but it's very important. It shows how much knowledgeable you are about financial terms. And even if when you're applying for a loan, they can trust that you understand how money works, how business works. So it's very important to know these for the definitions, okay, and the terms in short. So turnover is sales minus sales returns, okay. So if you look at definitions, turnover is net revenue from sales after deducting returns. So the actual money you make from sales, that is net turnover. Okay, so what are sales? Sales are total value of goods or services sold in a period. So maybe you've sold items. The amount of sold is 100 kwacha. That's not your turnover. That is sales. But from that sales, you have to subtract sales returns, which is the value of goods retained by customers. Okay, so maybe you sold 100, but maybe 30 were retained, or ones that whose values 30 kwacha were retained, meaning that the turnover is 100 minus 30, which is 70 kwacha. Okay, that's the turnover. So here is an example. A store records sales of 100,000 with returns of 5,000. What is the turnover? So turnover is 100,000 minus 5,000, which is 95,000. Simple calculations, right? So meaning that the net revenue is 95,000. Another example, a company sales of 250,000 with 100,000 in returns. Okay, a company sales of 250,000 with 10,000 in returns. What is then turnover? So the turnover is 250,000 minus 10,000, which is 240,000. One would wonder, if we sold 250 and 10 were retained, why can't we just record this? Yes, this is going to be recorded, but this also has to be recorded. Okay, if for example we have sold 250 and 250 were retained, questions have to be raised. Why is it that we made goods sale 250,000, but again 250,000 were retained? There must be something wrong with our products, with what we are selling. Okay, so that's the importance of recording the total sales and also the total returns, and also now knowing how much you've made from the sales. Okay, which is the turnover. So that's how it works. There's also another formula for turnover, which is cost of goods sold plus gross profit. Cost of goods sold plus gross profit. So the definition, of course, won't look at turnover. I've already discussed it, but cost of goods sold, which is abbreviated to COGS, COGS, it's direct cost of producing or purchasing goods sold. Okay, so what it means here is the cost of goods sold is you bought a phone at 10 kwacha, then you sell it at 30 kwacha. The cost of goods sold is 10 kwacha. Okay, the phone you sold, for you to buy it, for you to make it, for you to have it, you spent 10 kwacha. That is your cost of goods sold. Okay, then the gross profit, this is profit after subtracting cost of goods sold from turnover before other expenses. Okay, so what this simply means is you get the money. Okay, you get the profit, you get the money, then from that money, after you make a sale, from that money you subtract the cost of goods sold. So the phone you sold at 30 kwacha, you remove the 10 kwacha, you remain with the 20 kwacha. So that 20 kwacha is your gross profit. Okay, so remember, you bought a phone at 10 kwacha, you sold it at 30 kwacha. So now from that 30 kwacha, you remove that 10 kwacha which you used to buy the phone, you remain with the 20 kwacha. That is the gross profit. Okay, so here's an example. A bakery has cost of goods sold of 60,000 and a gross profit of 40,000. Okay, so the turnover is just the cost of goods sold plus the gross profit, which is 100,000. Okay, another example, a store has cost of goods sold of 150,000 and gross profit of 50,000. What is the turnover? So turnover is the cost of goods sold plus the gross profit, which is 150,000 plus 50,000, which will give us 200,000, meaning that the total sales are 200,000. Okay, so the fourth formula we're going to take a look at is called average stock, which is given by opening stock plus closing stock divided by 2. So opening stock plus closing stock divided by 2. So what is average stock? So average stock is just the average inventory value over a period. Okay, so you are in the business of maybe you sell chinos. Okay, so the average stock is the amount of chinos you had in a given period. Maybe in 1 year, you ask yourself, how many chinos did I had this year? In business, you ask yourself, what was my average stock? Okay, so you get average stock by adding opening stock and closing stock, then you divide by 2. What is opening stock? Opening stock is the inventory value at the period's start, which means when the year started, 2025, on New Year, 1st January, how many stocks did you, how many chinos did you had by then? Okay, maybe you had 10 chinos. That's your opening stock. So when you start doing your accounting, or when the business period has started, okay, how many did you had by that time? So let's say you had 10. That's your opening stock. Okay, the closing stock is the inventory value at the period's end. So by the end of the year, when 2025 ends, how many chinos do you have? You have 2. Okay, so now you do 10 plus 2, you get 12, right? Then you divide that by 2, you get 6. That's your average stock. Okay, so here is an example. A shop has opening stock of 20,000 and a closing stock of 30,000. What is the average stock? So the average stock is opening stock plus closing stock, then you divide by 2. 20,000 plus 30,000, it's 50,000. You divide 50,000 by 2, so 25,000 is the average stock. Example, a warehouse has opening stock of 80,000 and closing stock of 60,000. What is the average stock? So average stock is 80,000 plus 60,000 divided by 2. 80 plus 60, use a calculator. It's 140,000. Do you know that a calculator is allowed in commerce? Maybe most no, but it is allowed. Yeah, so 140,000 divided by 2. 140,000 divided by 2, it is 70,000. But even without a calculator, these are simple calculations, right? The next formula is cost of goods sold, COGS, the one we use when we're calculating turnover. So cost of goods sold is given by opening stock plus purchases minus closing stock. Okay, to know how many chinos you have sold, okay, you started with 10 chinos, you want to know how many chinos you have sold, so you need to get that 10. Okay, maybe as the business was going, you ordered 2 more chinos, so you started with 10 chinos, you ordered 2 more chinos, you now have 12 chinos. At the end of the year, you have remained with 1 chino. What does that mean? It means you sold 11 chinos, right? You started with 10, you have ordered 2, so you have 12. Then at the end of the year, you have 1 remaining, meaning that you have 11 chinos, right? So that's what this formula means. So you get your opening stock 10 plus your purchases 2, the ones you bought, minus the ones that have remained, maybe 1. So 10 plus 2, 12, minus 1, 11. So 11 is the amount you sold. Okay, so the definition, cost of goods sold, we defined it. Purchases is the cost of inventory bought during the period. The cost of inventory bought during the period. Okay, the amount of chinos you bought as the business was going. So here are the examples. A retailer has opening stock of 10,000. Then she has purchases of 50,000 and a closing stock of 50,000. What is the cost of goods sold? So the cost of goods sold is 10,000, which is the opening stock, plus the purchases 50,000 minus the closing stock 15,000, which gives us 45,000. Okay, so this is the cost of goods sold. Another example, a manufacturer has opening stock of 25,000, purchases of 100,000, and closing stock of 20,000. Okay, So the cost of goods sold is the opening stock 25,000 plus purchases 100 minus the closing stock at the end of the year 20,000, which gives us 105,000. Okay, so the cost of goods sold is 105,000. There's also another formula for cost of goods sold, which is average stock times rate of stock 10. So how do you choose which formula to use? Depending on what you have been given. Okay, so let's take a look at some definitions. So of course, cost of goods sold, we know the definition. Average stock, we know. Rate of stock return. So rate of stock return is the number of times average stock is sold and priced in a period. So the number of times the given average stock is sold and priced in a period. So as you keep on doing business, you have an idea of your average stock. You know that my average stock in a year is 6, meaning that every year you expect to have stock of 6. Okay, so using the average stock, when you multiply it, the number of times you sell 6 chinos, that is the rate of stock 10. Okay, so here's an example. A store has an average stock of 20,000 and the rate of stock 10 of 5. Okay, so the cost of goods sold is just the average stock 20,000 times the rate of stock 10, 5, which is 100,000. Another example, business has an average stock of 50,000 and the rate of stock 10 of 4. What is the cost of goods sold? So the cost of goods sold is 50,000 times 4, which is 200,000. Okay, going to number 7, formula number 7. So this formula number 7 is the same formula number 6 we're from looking at, but we have different struggles with mathematics, and this is not mathematics. This is commerce. For those who are good at mathematics, well, there's no need to know this formula because it's the same as formula 6. But for those who struggle with mathematics, of course, we'll look at a manipulation of the previous formula. So this is centered on calculating rate of stock 10. So rate of stock 10 is cost of goods sold at buying price divided by average stock at buying price. So buying price means the price at which you as a business bought the good. Okay, so key definitions: rate of stock 10 can also be redefined as the efficiency of inventory sales based on buying price. So efficiency means how good is your business in selling the items that you have, okay, based on the amount you bought them at. Okay, so our cost of goods sold at buying price is simply the cost of goods sold but measured at the original cost, that is the amount you bought those goods at. Okay, average stock at buying price is the average stock at purchase cost. Okay, so in short, we are measuring everything on the cost we bought the items at. Okay, so here are some examples. The first, a shop has cost of goods sold of 120,000 and an average stock of 30,000 at buying price. Calculate the rate of stock 10. So the rate of stock 10 is the cost of goods sold at buying price divided by the average stock at buying price. So 120,000 divided by 30,000, which is 4 times. Okay, another example. A company has a cost of goods sold of 300,000 and an average stock of 5,000 at buying price. Calculate the rate of stock 10. So the rate of stock 10 is just the cost of goods sold at buying price divided by the average stock at buying price, which is going to be 6 times. Don't forget to put times at the end of the answers. There is also the final formula for rate of stock 10. Okay, so this one is based on turnover at selling price and average stock at selling price, which is the only difference between this and that one is and the previous one, that is formula number 7, is this one is centered on selling price, while the previous one is buying price. Buying price is the price you bought that stock. Selling price is the price you sold that stock. we want to see if the profits we're making, if they are making our sales better or worse. Okay, you bought a phone at 20 kwacha, you sell it at 20 kwacha. Are you going to sell a lot of them? You buy a phone at 20 kwacha, you sell it at 30 kwacha. Are you going to sell a lot of them? Depending on the market, if you have the information of whether you sell a lot of them when you put a 10 kwacha profit or not, you can see how to adjust your profits. For example, if you are selling a lot at 20 kwacha than 30 kwacha, you can maybe increase just a bit, maybe 22 kwacha, so that you can be making a 2 kwacha profit if you want to be making a lot of sales. But if you are selling a lot at 30 kwacha, then the business is okay, which means the profit you added is good. Okay, that's why we're measuring these parameters. Hope that's clear. But anyway, we are just interested in knowing the formulas. Okay, so the definitions: rate of stock turn is the frequency of stock turnover based on selling price. Okay, and turnover selling price is the total sales revenue at the price goods are sold. Okay, and average stock at selling price is the average stock valued at its selling price. So here's an example. A retailer has turnover of 150,000 and an average stock of 30,000 at selling price. Okay, a retailer has turnover of 150,000 and an average stock of 30,000 at selling price. Calculate the rate of stock turnover. The rate of stock turn. So just get the turnover, okay, at selling price minus, divided by average stock at selling price. You get 5 times. Okay, a shop has turnover of 400,000 and an average stock of 80,000 at selling price. So the stock, the rate of stock turn is the turnover divided by average stock, which is 5 times. Next, we look at gross profit. So gross profit is turnover minus cost of goods sold. Gross profit is turnover minus cost of goods sold. Okay, so the key definition is, the first, of course, is gross profit. Okay, which is profit from sales before deducting operating expenses. So if you make 100 kwacha, okay, let me give something, a simple example. You sell cakes, okay? So to make that cake, you are spending 50 kwacha. Then you are selling the cake at 100 kwacha. So you sell that cake at 100 kwacha. Then the profit you have made is 50 kwacha, right? Or is it? Okay. Have you considered the cost, the cost of the airtime you use maybe to deliver, to talk to the client? Maybe the client called you, so you had to call back and stuff. Okay, have you considered the transportation cost? How much did it cost you to use Yango Daddy maybe to deliver that cake? Okay, so these other costs that are involved have not been subtracted yet. Okay, so that profit without that does not consider these other costs is called gross profit. So it is turnover minus cost of goods sold. Okay, here's an example. A business has turnover of 200,000 and cost of goods sold of 140,000. Find the gross profit. Okay, so the gross profit is simply the turnover minus the cost of goods sold. Remember, the cost of goods sold is the amount you used to make that cake, or to buy, if you're in the phone business, to buy a phone before you sold it. Okay, so the difference is the gross profit. A store has a turnover of 350,000 and cost of goods sold of 200,000. Find the gross profit. So it's 350,000 minus 200,000. Next, we look at net profit. So this is the profit that should make you excited, should make you jump if you have made a good net profit. Okay, if you go back to the example of the cake, okay, you made a profit of 50 kwacha as gross profit, right? Then the talk time cost or the airtime cost was 10 kwacha. The cost of bundles to advertise was 10 kwacha. The transportation cost was 20 kwacha, okay? And you are paying yourself 10 kwacha for the work done. So at the end of the day, the net profit is 0. You have not made anything, okay? You have just paid for the talk time, making Airtel or MTN rich or Zamtel rich. You have paid for transport, you're making Yango rich. And you have paid yourself because you're working, but the business has made nothing, okay? So net profit is the important one, which is gross profit minus expenses. The gross profit you got, the 50 kwacha, minus the cost of talk time, minus the cost of transport, minus the cost of you as a worker for your business, okay? So here are some key definitions. Net profit is the final profit after all expenses are deducted from gross profit, okay? And expenses are operating costs, e.g. rent, wages, utilities, airtime, transport, etc. So here's an example. A company has gross profit of 80,000 and expenses of 30,000. Find the net profit. So net profit is just the difference between the gross profit minus expenses, which is 50,000. The final example, a retailer has a gross profit of 120,000 and expenses of 45,000. Find the net profit. So net profit again is just the difference between the two, which gives us 75,000. Okay, that is enough for mathematics in commerce. And this marks the end of our financing business units.